Before you hear a single number, before anyone tells you where gold or silver is going, ask yourself one question. What happens when the system everyone trusts starts to hesitate? Because history is very clear. Wealth doesn't disappear in moments like that. It moves. Right now, something quiet but powerful is happening in global markets. It's not flashing on your screen every day. It's not trending on social media, but the largest institutions on earth are preparing for a future that looks very different from the one we were promised. Governments are borrowing more than ever. Currencies are being tested. Confidence is becoming conditional. And when confidence changes, money follows a very old instinct. Gold and silver are no longer just metals. They are signals that central banks are sending when they buy quietly instead of talking loudly. Signals that investors are reading when interest rates no longer protect purchasing power. Signals that tell you the rules of the game are evolving, not collapsing, but shifting. And those who recognize the shift early are never the ones scrambling later. Here's the uncomfortable truth most people don't want to hear. The biggest moves in financial history don't begin with panic. They begin with complacency. While the crowd argues about tomorrow's headlines, long-term capital positions for the next decade. And right now, that capital is asking one question: what still holds value if everything else is repriced? That question brings us to 2026, because 2026 is not just another year on the calendar. It's a checkpoint, a moment where years of policy decisions, debt accumulation, inflation pressure, and geopolitical tension converge. And at that point, gold and silver won't be reacting. They'll be revealing what the market already knew. If you think this conversation is about guessing prices, you're missing the point. This is about understanding why prices move, who moves them, and when the world quietly agrees that safety is worth paying for. So stay with me, because by the time this ends, you won't just hear where gold and silver could be in 2026. You'll understand why the smartest money on the planet is already positioning for it today. Gold in 2026 is not a story about speculation. It is a story about structure, confidence, and power. When you look past the noise of daily price moves and focus on the forces shaping the global financial system, one reality becomes clear. Gold is being repriced for a world that no longer trusts stability the way it once did. Forecasts for 2026 vary, yes, but the direction is remarkably consistent. We are talking about a market that increasingly accepts gold in the $4,000 to $5,000 per ounce range as not extreme, but logical. Why? Because capital always moves towards certainty when uncertainty becomes permanent. Inflation may fluctuate, interest rates may rise or fall, but confidence once lost is not easily restored. Governments across the world have accumulated unprecedented levels of debt, and central banks have been forced into policy decisions that trade long-term discipline for short-term relief. Investors see this clearly. They understand that fiat systems depend on trust, and trust today is fragile. Gold benefits from this environment because it does not rely on promises. It does not depend on earnings projections, political stability, or quarterly growth targets. It exists outside the system, and in moments like these, assets outside the system gain relevance. That is why major financial institutions are not asking if gold prices will be higher by 2026. They are debating how much higher. A base case scenario places gold comfortably above previous historical highs, supported by steady central bank demand, moderated interest rates, and a global economy still searching for balance. A more aggressive scenario assumes persistent geopolitical tension, slower economic growth, and a weaker dollar, conditions under which gold doesn't just rise, it accelerates. In those environments, $5,000 per ounce stops sounding like a headline and starts sounding like math. What matters most is not the exact number, but the repricing of risk. Gold is no longer treated as a hedge of last resort. It is increasingly viewed as a strategic reserve asset. Central banks understand this. Sovereign wealth funds understand this. Long-term capital understands this. And when institutional capital shifts its mindset, price follows. Skeptics will argue that higher yields compete with gold. That argument assumes yields remain meaningfully positive after inflation and stable over time. History shows that assumption rarely holds. Others will claim that once uncertainty fades, gold will retreat. But the world is not reverting to simplicity. The financial system is becoming more complex, more interconnected, and more politically influenced, not less. Gold's value in 2026 will reflect that reality. It will reflect a world where diversification is no longer optional, where liquidity matters, and where preservation of purchasing power outweighs short-term performance. Whether the final number settles closer to 4,000 or pushes toward 5,000, the message is the same. Gold is being redefined not as a relic of the past, but as a necessity for the future. And markets always reward what becomes necessary. The real engine behind gold's strength moving into 2026 is not retail speculation or short-term fear. It is institutional behavior, and more specifically, central banks acting with strategic intent. When the largest, most conservative players in the financial system quietly and consistently change course, it signals something far deeper than a temporary trade. Over the past few years, central banks have not just increased gold holdings, they have accelerated them. That trend is not cosmetic, it is deliberate. Central banks operate on decades, not quarters. Their mandate is not to chase returns, but to preserve sovereignty, liquidity, and confidence. When they allocate capital, they do so because they are planning for stress, not optimism. Gold fits that mandate perfectly. It carries no counterparty, risk, no political conditions, and no dependence on another nation's balance sheet. In a world where reserve currencies are increasingly weaponized and geopolitical alignments are shifting, that independence matters more than ever. By 2026, this demand is expected to remain structurally strong. Emerging market central banks in particular are diversifying away from traditional reserve assets, reducing overexposure to a single currency system. This is not a rejection of the global financial order. It is an adaptation to its evolving risks. Gold becomes the neutral anchor, the asset that cannot be frozen, diluted, or politically negotiated. This steady accumulation creates a powerful floor under prices. It changes the supply-demand equation in a way that is not easily reversed. Mine production does not respond quickly to higher prices. New supply takes years, sometimes decades, to come online. Meanwhile, central bank demand is price insensitive. They are not buyers at the margin, they are buyers by policy. That combination is rare in any market, and when it exists, it reshapes valuation. Private capital pays attention to this. Institutional investors understand that when central banks act in unison, they are signaling long-term risk management, not tactical positioning. As a result, gold's role expands from a hedge to a core allocation. Pension funds, insurance portfolios, and sovereign funds increasingly treat gold not as an alternative asset, but as a stabilizer, a way to offset systemic exposure elsewhere. Critics argue that central bank buying is cyclical and could reverse. That underestimates the structural forces at play. The drivers behind this shift, geopolitical fragmentation, elevated debt levels, currency volatility, are not short-lived. They are features of the current environment, not bugs. And as long as those features persist, gold retains its relevance. By 2026, gold prices will not simply reflect inflation expectations or interest rate forecasts. They will reflect a deeper truth, that the institutions responsible for safeguarding national wealth are preparing for a world where resilience matters more than efficiency. When the most conservative actors in finance move decisively, markets follow, not because of emotion, but because of logic. And logic, when combined with scale, has a way of becoming permanent. Silver's trajectory toward 2026 tells a fundamentally different story than gold, and that difference is precisely why it matters. Silver is not just a monetary asset, it is an industrial input, a technological enabler, and a reflection of real economic activity. That dual identity gives silver a unique advantage in the coming years, but it also introduces volatility. Understanding silver's future requires understanding how modern economies are being built. The world is in the middle of an infrastructure and energy transformation, electrification, renewable energy, electric vehicles, advanced electronics. All of these systems rely on silver for its unmatched conductivity and efficiency. Unlike many commodities, silver does not have a perfect substitute. You can engineer around it, but you cannot replace it without sacrificing performance or cost. As industrial demand expands, silver consumption grows quietly but persistently. By 2026, this demand is expected to be materially higher than today. Solar installations alone continue to consume significant quantities of silver, and global energy policy remains committed to expanding renewable capacity. Add to that electric vehicles, charging infrastructure, data centers, and high-precision electronics, and you begin to see why silver's demand profile is structurally different from the past. This is not cyclical growth, it is embedded growth. On the supply side, silver faces constraints that are often overlooked. The majority of silver production is a byproduct of mining for other metals such as copper, zinc, and lead. That means silver supply does not respond directly to silver prices. Even if prices rise sharply, production cannot quickly adjust. This creates a market where demand can increase faster than supply, a classic setup for sustained upward pressure. At the same time, silver retains its monetary appeal. When inflation concerns rise or confidence in fiat currencies weakens, silver historically benefits alongside gold. But silver's smaller market size amplifies price movements. Capital flows that barely move gold can dramatically impact silver. That is why analysts project silver prices in 2026 potentially ranging into the mid-50s or higher, assuming continued industrial expansion and stable investment demand. However, silver is not a straight line upward. Its volatility is part of the equation. Economic slowdowns, tightening financial conditions, or temporary drops in industrial output can create sharp corrections. But those corrections do not negate the long-term thesis, they reset entry points. Long-term capital understands this distinction. What's separate? A silver from most assets is leverage, not financial leverage, but economic leverage. Small changes in demand or supply produce outsized effects on price. In a world investing heavily in electrification and automation, that leverage becomes increasingly valuable. By 2026, silver will not simply be priced as a precious metal or an industrial commodity. It will be priced as a strategic material, one tied directly to how the global economy evolves. Investors who understand this are not chasing volatility. They are positioning for structural change. And in markets, structural change always outlasts sentiment. Markets do not move in isolation. They move in response to policy, liquidity, and confidence. As we look toward 2026, the pricing of gold and silver will be shaped less by emotion and more by the cumulative impact of monetary decisions made over the past decade. Interest rates, currency strength, and global liquidity are not abstract concepts. They are the levers that determine where capital flows when risk is redefined. The assumption that higher interest rates permanently suppress precious metals is overly simplistic. What matters is not nominal rates, but real rates, returns after inflation. When real yields are compressed or unstable, the opportunity cost of holding gold and silver diminishes. Investors are not comparing metals to yields in theory. They are comparing them to purchasing power in reality. And purchasing power across much of the world has been eroded. By 2026, monetary policy is expected to be more constrained than in the past. Governments carry record debt loads, and central banks are forced to balance inflation control with economic stability. This limits how aggressive policy tightening can realistically be. Even if headline rates remain elevated, policy flexibility is reduced. That environment favors assets that are not dependent on policy credibility. Currency dynamics further reinforce this case. The US dollar remains dominant, but dominance does not mean invulnerability. Persistent deficits, expanding money supply, and geopolitical fragmentation place long-term pressure on fiat currencies. When currency volatility rises, gold and silver regain relevance as neutral stores of value. They are not bets against a currency, they are insurance against instability. Liquidity cycles also play a critical role. Periods of tightening reduce speculative excess, but they also expose fragility in leveraged systems. When liquidity returns, as it inevitably does, capital seeks assets that can absorb flows without political or counterparty risk. Precious metals, particularly gold, have historically benefited during these transitions. Silver, with its smaller market size, responds even more dramatically. Economic growth expectations matter as well. A soft landing supports industrial demand for silver while maintaining investor interest in gold. A harder landing increases safe haven demand across both metals. In either scenario, the downside is limited by structural demand, while the upside remains asymmetric. That is a rare profile in any asset class. What investors often underestimate is how long policy consequences persist. Decisions made to stabilize markets today create imbalances that surface years later. Gold and silver do not react instantly, they respond when those imbalances become visible. By 2026, the cumulative effects of stimulus, tightening, and fiscal expansion will be fully reflected in asset pricing. This is not about predicting a single macro outcome. It is about understanding probability. Precious metals perform best when certainty declines, when policy options narrow, and when confidence becomes conditional. Those conditions are not hypothetical, they are observable. Markets reward preparation, not prediction. And in an environment shaped by constrained policy and shifting liquidity, gold and silver are positioned not as trades, but as strategic assets aligned with the reality of modern finance. By the time we reach 2026, the conversation around gold and silver will no longer be about short-term price targets. It will be about positioning in a world defined by uncertainty. Markets have entered an era where traditional assumptions about stability, diversification, and risk are being challenged. In that environment, assets are valued not just for return, but for resilience. Gold and silver sit at the center of that shift. Investors are increasingly forced to confront a reality that was once theoretical. Correlations rise under stress. Equities, bonds, and currencies that are designed to balance each other often fail to do so when volatility accelerates. That is when assets outside the financial system matter most. Gold and silver do not exist because they generate cash flow. They exist because they preserve optionality. They give capital flexibility when other instruments do not. Scenario analysis is essential here. In a base case environment, moderate growth, controlled inflation, and gradual policy normalization, gold maintains elevated levels supported by institutional demand and constrained supply. Silver benefits from steady industrial expansion and selective investment flows. In a more adverse scenario, geopolitical escalation, financial instability, or policy missteps, both metals reprice sharply higher as capital seeks protection. Even in a surprisingly optimistic scenario where growth accelerates and confidence improves, downside is limited by structural demand and years of underinvestment in supply. This asymmetry is what long-term capital focuses on. Downside protection combined with upside potential is rare, particularly at scale. Gold offers stability, silver offers leverage. Together, they form a complementary strategy rather than a redundant one. This is not about replacing other assets, but about reinforcing portfolios against outcomes that are increasingly plausible. Another critical factor is time horizon. Short-term traders focus on volatility. Long-term investors focus on durability. Gold and silver reward patience because they respond to structural trends, not headlines. Debt accumulation, demographic shifts, technological transformation, and geopolitical realignment are slow-moving forces, but their impact on asset pricing is profound. By 2026, those forces will be impossible to ignore. What often gets overlooked is psychology. Confidence is the most fragile component of any financial system. It can persist longer than expected and then disappear suddenly. When that happens, liquidity becomes selective and trust becomes scarce. Gold and silver function as bridges during those moments, assets that retain value when narratives collapse. The market does not price insurance when it feels unnecessary. It prices it when risk becomes visible. Precious metals sit in that gap between complacency and crisis. They are not designed to outperform in every environment. They are designed to endure across environments. As investors look ahead to 2026, the question is not whether gold and silver will matter. It is whether portfolios are prepared for a world where certainty is conditional. Markets evolve, risk evolves, assets that adapt survive, and in finance, survival is the foundation of every long-term success. And now, as we step back from the charts, the forecasts, and the numbers, one final thought should stay with you. Markets don't warn you before they reprice reality. They don't ring a bell. They don't send a notification. They move quietly. And then all at once, by the Tim. 2026 arrives, gold and silver will not be asking for attention. They will already have it. Not because of hype, not because of fear, but because the world will have made a collective decision about what it trusts. And trust, once redirected, rarely moves back overnight. The question isn't whether prices will be higher or lower on a specific day. The real question is this: will you understand the move when it happens, or will you be reacting to it after the story is already written? Because history rewards those who position before certainty, not those who wait for confirmation. Every major financial shift looks obvious in hindsight, every one of them. But while they're unfolding, they feel uncomfortable, slow, and easy to ignore. That's where we are now, in that quiet space where signals matter more than headlines and preparation matters more than prediction. Gold and silver have survived empires, currencies, and crises, not because they are perfect, but because they are independent. They don't rely on confidence, they absorb it when everything else is questioning itself. And when that moment comes, markets don't ask permission to move. So as you think about 2026, don't focus on a number, focus on readiness. Because when the shift becomes visible, the opportunity to prepare is already gone. If you want to stay ahead of that shift, if you want to understand the signals before the crowd feels the impact, stay connected. This conversation doesn't end here. The real story is still unfolding, and the smartest move is making sure you're still listening when the market stops whispering and starts speaking.